Welcome to Breaking News to Trading Moves.
Good to be here.
Today we're looking at the transportation sector and specifically focusing on a really key headline event, J.B. Hunt's Q4 2025 earnings report.
Right.
And on the surface, the headline number, it looked positive. They beat earnings expectations. But then the reaction in the market, not so much. The stock actually traded lower.
Yeah, and that's a contradiction that, often confuses traders. You see a green number on the earnings per share. It suggests the company's doing well, but then you see a red number on the stock price.
So the goal today is to explain exactly why that happened.
The immediate answer, really, it lies in the makeup of those numbers. Yes, the bottom line looked good, but revenue and pricing, well, they remain soft.
Okay.
Right now, investors are looking very closely at the type of profit the company generated.
They aren't just looking for profit. They want to see actual growth.
Exactly. The market is focused on two specific things. First, they really want to know when freight pricing is going to turn upward. They want to see demand driving those rates higher.
Yeah. And the second thing?
Second, there's some anxiety about whether the recent market rally had already accounted for a recovery that just hasn't fully shown up yet.
So the market might have gotten a little ahead of itself, expecting a recovery sooner than the data supports.
That's the main concern. If the stock went up expecting an immediate improvement, and this report suggests a delay, then the stock price has to adjust downward.
All right, let's lay out the plan for this discussion. We're going to analyze the headline numbers from J.B. Hunt to understand the reasoning. Then we'll look at how this impacts other parts of the market.
The whole ecosystem.
Yeah, we've got a list of winners, rails, brokers, and equipment manufacturers. And then we have a list of losers, which covers truckload carriers, delivery services, and even retailers.
It's a full review.
Okay, let's start with that headline analysis.
Yeah.
J.B. Hunt Q4 2025. What were the actual numbers?
So the earnings per share, or EPS, it came in at $1.90, and that is up year over year.
That sounds positive.
It is. But then you look at the top line. Revenue was $3.10 billion, which is down 2% year over year.
And that's the problem.
That is the sticking point. I mean, it's technically a beat against what analysts were expecting for EPS, but that revenue decline tells the market the business isn't growing its sales.
So if revenue went down, how did the earnings go up? Usually those two things move together. How do they do that?
It really comes down to cost takeouts and productivity. Essentially, they just reduced their expenses.
Got it.
Their operating income improved because the company pushed through some structural cost reductions and, really improved their network efficiency.
So they spent less money to generate that profit.
They got more efficient. And efficiency is, of course, a good thing. However, from a trader's perspective, there's a limit to how much a company can cut costs. Eventually, you need top-line growth.
The market wants proof of sustained pricing gains.
Correct. They want to see that customers are willing to pay more, not just that J.B. Hunt is spending less. Cost control is a defensive move. Pricing gains are an offensive move. The market is looking for offense right now.
Let's get into the operational details. I keep hearing about the freight tape. What is that telling us?
It's mixed. If you look at their intermodal volumes, that's shipping containers moving by both rail and truck, it was down overall, year over year, but there was a divergence in there.
A split.
Yes. The Eastern network was actually up. But the Transcontinental network, that was down.
And why does that geographical detail matter?
Well, it shows the weakness isn't uniform. The transcontinental lines, they're often tied to imports coming into the West Coast and then moving across the country.
Right.
Weakness there signals something different than strength in this shorter haul Eastern network. It suggests that maybe import volumes are still struggling.
And then there's the final mile segment.
Right. That remains soft. And management flagged a very specific issue for the future. They noted a revenue headwind for 2026 that is tied directly to a lost final mile customer.
So they lost a contract, and that's going to impact them next year.
Exactly. It just adds to the whole narrative that the growth story isn't quite ready yet.
Okay, that covers the J.B. Hunt story. It's a beat on earnings, but a miss on the quality of those earnings because of revenue and softness in some key areas.
That's the summary.
Now, let's look at the other sectors. Let's talk about the winners.
Let's do it.
Category 1, intermodal railroads. How does J.B. Hunt's report point us toward the railroads?
It goes right back to that idea of highway to rail conversion. J.B. Hunt uses rail networks for their intermodal business. So their commentary suggests that if intermodal demand stabilizes, the rail networks are the ones that see better utilization.
Because they own all the infrastructure.
Right. They have very high fixed costs. So as soon as you put more volume on those tracks, even if it's just a stabilization, their operating leverage kicks in.
They make better margins.
Much better margins. And J.B. Hunt's discussion about their network mix, it suggests that rail is a key beneficiary if the freight market starts to tighten up.
So who are the players to watch here?
Well, you're looking at the major rail networks, specifically Union Pacific.
That's ticker UMP,
Then you have CSX
ticker CSX,
and Norfolk Southern.
ticker NSC.
These are the networks that really benefit when that intermodal volume starts moving efficiently.
Okay, moving on to category 2 of the winners, freight brokerage and asset-light logistics.
This is a sector that often does well during uncertain times.
Why is that? What's the asset-light advantage?
Okay, think about J.B. Hunt. They own trucks. They own containers. They have assets. When demand drops, those assets can sit idle and they cost money.
Mm-hmm.
An asset-light broker doesn't own the trucks. They just match a shipper with a carrier.
They're the intermediary.
Yes.
Yeah.
And when capacity tightens or routing gets complex, which is what happens when the market is trying to turn brokers' benefit, they just see higher transaction activity.
So a choppy market actually helps them.
In a way, yes. A difficult turn in freight, it boosts the value of flexible capacity. If a shipper can't easily find a truck, they call a broker.
And the brokers can manage the spread.
They manage the spread, the difference between what they charge the shipper and what they pay the trucker, and they can generate better gross profit per load.
Which companies fit this description?
C.H. Robinson is the main name here.
That's ticker CHRW.
And another one to watch is RXO.
Ticker RXO.
These are companies that can really use the complexity that challenges the asset-heavy carriers.
Let's look at category 3 for the winners, commercial trucking equipment. Now this one feels a little contradictory. If freight is soft, why would companies be buying new trucks?
It's all about looking forward. We call it the fleet refresh cycle.
How does that work?
Well, trucks wear out. And for the last few years, carriers might have delayed buying new ones because the market was down. But if there's any indication of a broader recovery, or if they win new dedicated contracts, they have to order new trucks.
They need to be ready before the demand actually shows up.
Exactly. Production planning takes time. You don't order a truck today and get it tomorrow. These stocks move early because the market anticipates that carriers will start placing orders to prepare for that upswing.
Okay.
Even just a modest improvement in demand can trigger this.
So who are the manufacturers?
PACCAR is a major one,
Ticker PCAR.
and WABCO Holdings.
Ticker WNC.
You'd watch these for signs that the carriers themselves are starting to invest in their own infrastructure again.
Okay, those are the winners. But a market movement like this usually has a negative side for some. Let's talk about the losers. Who is negatively impacted by the scenario J.B. Hunt described?
The first category here would be the spot-exposed truckload carriers.
How is that different from J.B. Hunt?
Well, J.B. Hunt has a lot of dedicated contracts in the big intermodal business. Spot-exposed carriers, they rely more on the daily market price of moving freight.
Ah.
In a market where the turn is weak or it's still early, they are in a really difficult position.
Why is it so difficult for them?
Because they face soft contract resets, meaning their regular customers want to pay less, and they face unpredictable spot conditions.
So their revenue is under pressure.
And potentially their costs, too. This is the margin danger. If volumes improve, so they're driving more miles, but pricing lags, they're doing more work for the same or less money.
And that squeezes them.
It squeezes their profitability, especially if the cost of purchase transportation rises faster than their revenue.
Who are the companies in this category?
Knight Swift Transportation,
Ticker KNX.
Werner Enterprises,
Ticker WERN.
and Schneider National.
Ticker SNDR.
These are all solid companies, but in this specific setup, where pricing hasn't turned yet, they face challenges.
Category 2 of the losers. This brings us back to that final mile issue. Last mile and parcel delivery.
Yeah, this connects directly to what J.B. Hunt reported about their own final mile weakness.
The big and bulky goods.
Right. Refrigerators, furniture, exercise equipment. Softness there implies that retailers are being cautious, they aren't stocking up, and consumers aren't buying as much of these heavy items.
And does that sentiment extend to other areas?
It definitely spills over into the broader delivery names. If end market demand isn't accelerating, these stocks get weighed down. I mean, if consumers aren't buying large items, UPS and FedEx just have less volume to move.
So the tickers here are the big delivery firms.
UPS
Ticker UPS.
and FedEx.
Ticker FDX.
Yeah, they really act as bellwethers for that consumer demand.
Finally, category 3 of the losers. Large freight spenders, the retailers.
This is the other side of the coin. We just discussed how the market wants J.B. Hunt to raise its prices.
Right.
So if J.B. Hunt raises prices, who pays the bill?
The retailers.
Exactly. It's an inverse relationship. If freight tightens and rates rise, it creates cost pressure for the big shippers.
So if the transportation sector recovers, the retail sector could face some margin pressure.
Potentially. Especially for those retailers selling bulky goods where shipping is a large percentage of the final cost. It directly threatens their margins.
Who should we be watching here?
Target is a prime example.
Kicker TGT.
And Home Depot.
Ticker HD.
Yeah, Home Depot specifically because of that clear link to home improvement and heavy goods. If it costs more to move lumber and appliances, that affects their bottom line.
So one company's earnings beat is another company's margin pressure.
That's how the market works. All these sectors are connected.
Okay, we've got the overview for Q4. Looking ahead, what should traders be watching for next? What are the specific indicators for early 2026 based on this report?
There are 4 key signals to watch. First, and this is the most important, is evidence of sustained pricing improvement.
We need to see those rates actually go up and stay up.
Yes, you need to watch the contract resets and the spot rate trends. If those stay flat, the recovery just isn't there yet.
What's the second signal?
The evolution of that intermodal mix. Remember the Eastern versus Transcontinental split we talked about?
Eastern strength, Transcontinental weakness.
Watch if that changes. If the Transcontinental network starts to pick up, that's a very positive signal for the broader economy. It means imports are moving again.
And the third signal?
The balance between cost reductions and rising purchase transportation costs. J.B. Hunt showed they can cut their own costs. Now, the question is whether they can maintain those margins if the cost of hiring third-party trucks goes up.
And the fourth signal?
It's updates on that customer concentration risk in the final mile segment. We need to see if that lost customer was just an isolated event or if it signals a broader trend of customers leaving or scaling back their business.
A lot of it comes down to those specific data points.
It always does.
So as we wrap up, I want to leave everyone with a final thought. We have this sentiment of beat but not good enough.
That's the mood of the market right now, for sure.
Is the transportation sector basically signaling a delay in the recovery? Is it a recovery later story rather than the recovery now that the market was hoping for?
That is the core question. The market rallied, expecting recovery now. J.B. Hunt's report suggested recovery later. And that timing difference is where the trading opportunity lies.
Thank you for breaking it all down with us.
You're very welcome.
And before we go, a quick reminder. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We will catch you next time.